Good day, doctor. So we are from group 2 and today we are going to solve problems from the tutorial 2. So my name is LAVANYA LAKSMI and my group members are NURUL, Asyura, BINTI, Azizan and DHIA QISTINA, BINTI, JOHARI. So here we have provided the Excel link to show our calculations for each questions.
These are our table of contents.
Question 1. Calculate for each of the following bonds the current yield and yield to maturity per $1,000 of par value, which is a face value, assuming both situation of annual and semi-annual coupon payments. So for question 1, we need to find the current yield and yield to maturity for bond A until bond D for both annual and semi-annual. For problem 1, we need to know the formulas for three things. First is the annual coupon payment, where the coupon rate times with the bond's face value. Next is the current yield, annual coupon payment divided by current bond price. Next is the yield to maturity, YTM, where the annual payment plus face value minus market value divided by years to maturity. And overall we have to divide by the value of face value plus market value divided by 2. Next step is we have to find the annual and semi-annual current yield for bond A until bond D. So as we need to find annual coupon payment for bond A, for an example, the formula is coupon rate times with bond's face value. So the coupon rate for bond A is 6% times with the face value, which is $1,000. Then we will get $60. We can do the same method for rest of the three bonds. Next is the semi-annual coupon payment. Semi-annual coupon payment is where the bondholder will be paid every 6 months, which means 2 times in a year. So we can just divide the $60 for bond A, annual coupon payment, divide by 2, then we'll get $30 for bond A. The rest we can do the same method for bond B until bond D. Next is the current yield, annual. The formula is annual coupon payment divided by current bond price. So the annual coupon payment for bond A, we got $60. $60 divided by the current market price for bond A is $980. So we'll get 6.12 current yield, which is annually. This is for annual. Next, the semi-annual, we can take the semi-annual coupon payment, $30. Divided by the current market price for bond A is $980. After we divide, we will get 3.06% for semi-annual current yield for bond A. For rest of the bonds, we can follow the same methods. Now we can find the yield to maturity annually. So we are going to find for annually. First, we have to list out the informations that are given in the question, as like par value, coupon rate, years to maturity, annual coupon payment that we found just now, payments per year. For annually, the bondholder will be received once a year, will be paid once a year, so it's 1. Current value, Here I have found the YTM through financial calculator and also the Excel calculations. As for the Excel calculations, you can refer to the Excel file that we have given in the first page. Now we can find we will find the yield to maturity by using the financial calculator. So first we need to change our financial calculator into 1 year, 1 year. Then we can insert the years to maturity, which is 8, and the current value, which is 980. We have to put negative 980 PV, then the PMT, which is the annual coupon payment, $60, then the face value, which is the par value, 1000 face value. Then we can find the YTM is 6.33. We can follow the same method for the rest of the bonds, bond B, bond C, bond D. I got the same answer, same YTM, with using both of the financial calculator and also the Excel calculations. Next, the yield of maturity semi-annually. Semi-annually means the bondholders will be paid twice a year. So in this case, all the information will be same except for the semi-annual coupon payment, which we have to divide by 2. We will get, for bond A, we will get $30. For bond B, $40, bond C, $35, and bond D, $40. And for payments per year, it's 2 because they will be paid twice a year. So by using Excel calculations, you can refer to the Excel file. By using financial calculator, we got for bond A, we got 3.29%, and rest of the bonds also we followed the same method. Okay, so the next question is the relationship between the coupon rate, current rate, and YTM, yield to maturity, between all these 4 bonds. So as for the coupon rate, if the price of the bonds decrease so that the buyer can realize the capital appreciation when the market yields increase above the coupon rate at a specific moment in a time. So in this case, the bond A and bond C are selling at a discount because they are sold for less than its par value, and its YTM is higher than its coupon rate. As for bond B and bond D are considered to be selling at a premium because their price exceeds its par value and their YTM is lower than their coupon rate. For current yield, a lower current yield is the result of a higher bond price and vice versa. In this case, the current yield for bond A and bond C that are trading below par is greater than their coupon rate. The current yield on bond B and bond D that are trading above the par rate have a lower current yield. Next is the YTM. The YTM is the present value of all future cash flows, including coupon payments and final redemption, is equal to the current market price. This is also known as the rate of return, which is the IRR. In this case, the bond A and bond C are trading below the par, thus their YTM is more than their coupon rate. The bond B and bond D are selling above the par, thus their YTM is lower than the coupon rate. That's all from me. Thank you.
Hello Dr. Azlin, I am NURUL Asyura and I will present question 2. Elon Enterprise bonds currently sell for $1,150, have an 10% coupon interest rate, and the par value is $1,000, the pay interest annually, and have 18 years to mature. Alright, so we're moving on to the question A. Question A asks us to calculate the bond's current yield. Okay, the formula that I use to calculate the bond's current yield is annual coupon divided by the current bond price. Okay, the given annual interest payment in this question is 10%. So I take the 10% times of $1,000 and I get $110 for the annual interest payment. And then the current market price is $1,150. So we can calculate the bond's current yield, which is 110 divided by the 1,150. And I get the answer, which is 0.0957. So I convert to the percent and then I get the answer, which is 9.57% for the bond's current yield. Moving on to the question B, calculate the bond's yield to maturity YTM. Okay, so to find the YTM, I use Excel and also this formula to get the exactly value of YTM. Okay, so the face value of bond that given in this question is $1,000. The annual coupon rate is 10%. The number of years in maturity is 18 years. The price of bond is $1,150 and the last one is annual coupon is $110. Okay, so I use the Excel and fill the values and I get the answer, which is 9.46% for the YTM. Next, question C. Compare the YTM calculated in part B to the bond's coupon interest rate and the current yield in part A. Use a comparison of the bond's current price and par value to explain these differences. Firstly, the coupon interest rate is 11%, the current yield is approximately 9.57% and the YTM is approximately 9.95%. So the current yield is lower than the coupon interest rate because the bond is selling at a premium, which is $1,150 is more larger than $1,000. And the last one, the YTM is higher than the current yield because it takes into account the capital gain or loss upon maturity, and considering the difference between the purchase price and the par value.
Assalamualaikum and a good morning, Doctor. I'm JOHARI and I'm going to present question 3. So here it asks for calculate total returns for bond A and bond B, and for second question is which bond have higher total return. So now to tackle the first question, I'll be starting the calculation with bond A semi-annual. And the first step is to compute total coupon payment plus interest on interest based on the assumed reinvestment rate using the following formula. And this is semi-annual. So some of the data in the formula need to be divided and to be multiplied by 2. And I jot down all of the data from the statement questions, and the answer is $291.76. Okay, now let's calculate step 2, which need to be determine the projected sales price at the end of the planned investment horizon. And as you can see here, I stated two type of calculation which can be calculated using financial calculator. But for me, I using the Excel and double check with my financial calculator answer. So with Excel, we're using the formula of PV and as shown as stated, and the answer is $1,368.82. Continue with step 3, which is just add on the answer in step 1, and step 2, which is resulted to $1,660.58. And we'll continue with the last step, which is to obtain the semi-annual total return. So we just jot down and using the formula, and it stated that N is the total number of semi-annual periods, and it is 14, which can already been calculated in previous step, and the answer resulted to 3.89%. However, as this bond is semi-annual and the interest is also being paid semi-annually, we need to double up the interest rate, which is using the answer in step 4, which is 3.89%, and multiply by 2 and you will get 7.78%. Okay, now let's proceed with bond B, which is annual. The calculation is kind of similar with bond A, but then bond A is semi-annual. So we'll start with the step 1, which is compute the total coupon payment plus interest on interest based on assumed reinvestment rate using the formula. And as calculated in the table and using the formula, we jot down all of the data from the question and resulted to $206. And then we need to proceed with step 2, which is determine the project sale price at the end of the planned investment horizon. And like I stated before, there's 2 calculations you can use, which is using the Excel and the financial calculator. And I'm using Excel, using the formula PV, insert the data, and I double check with my financial calculator answer, which is resulted to $987.67. So for step 3, just add on the values computed in step 1 and step 2 and resulted to $1,193.67. And in step 4, we need to obtain the annual total return using the formula. And we jot down all of the data and it resulted to 8.32%. So the conclusion, we can say that bond A earned 7.78 total return from purchasing $972.94 and sell it at the price of $1,660.58, while bond B earned 8.32 total return from purchasing $939.25 and sell it at the price of $1,193.67. So we can see that bond B have higher total return, which is 8.32. That's all from me. Thank you.
Moving on to the last question, question 4. Cite major shortcomings for each following fixed income yield measures. So firstly, current yield. which is it ignores time value of money. The current yield only considers the coupon payments in relation to the current market price of the bond. Next, it also does not account for changes in market price, which is it doesn't reflect any changes in the bond's price that may occur over time. Okay, the next point is yield to maturity. Since yield to maturity makes assumptions about the future, there is chance that the bond issuer may default and investors will not be able to reinvest all of the coupons and the bond will not be held to maturity. And the last point is realized compound yield, which is a constant reinvest assumption. We also know that compound yield relies on the assumptions that coupon payments are reinvested at the bond's yield to maturity, which is YTM, consistently throughout the investment period. So this assumption may not align with actual reinvestment opportunities available to investors and potentially leading to inaccuracies in yield calculations. The last one is interest rate volatility, which is realized compound yield does not factor in changes in interest rate over the investment horizon. So the fluctuations in the interest rate can impact the reinvestment of coupon payments and the realized yield, and also making it less reflective of the true return experienced by the investors. That's all from us, Group 2. Thank you for listening.